Hello, and thank you for joining us at XM.com for this special report. The earnings season is just around the corner. Markets are bracing themselves for the quarter one releases. I'm Christina Marujos. With me today is our investment analyst, Stefanos Konomidis. Stefanos, let's look at the stock markets. How did they fare during this first quarter, which of course was disrupted by the turmoil we saw in the banking sector?
Hello, Christina. You are right. The uncertainty within the banking sector after the unexpected collapses of some US regional banks was the main market theme in the first quarter, and most would expect that it would be negative for risky assets and stocks. However, we saw another instance of the bad news is good news for equities, as investors increased their bets of a less aggressive monetary tightening path in the Fed's effort to contain any systemic failures. Now, faster rate cuts and lower interest rates in general are of course good for stocks as they increase the value of their future cash flows. And that's why major US indices ended the quarter with gains despite the macroeconomic backdrop deteriorating.
Now, turning to the releases themselves, what should investors expect in the upcoming earnings season? And what are the main risks surrounding equity markets right now?
Well, earnings are set to contract for a second consecutive quarter as the overall economy is slowing down due to the prolonged period of extremely high interest rates. Now, the main risk, as always, is for the actual numbers to come significantly worse than anticipated. But this time, I think we have reasons to believe that the odds for such a scenario are higher. Most leading indicators are signaling a recession, and this time neither the Fed nor the economy will be able to step in and bail out these underperforming companies, especially without triggering another inflationary wave or other systemic cracks in the economy. So, firms that fail to deliver the anticipated results could be severely punished this time, and the latest market rally could reverse if that happens.
And finally, Stefanos, looking ahead, what is the outlook for US stocks? And do you think that the risk to reward ratio is attractive here?
I think that from where we are standing now, the outlook for stock markets is bearish. But let me elaborate on that. Stocks currently retain hefty valuations as if investors are only pricing in the bullish scenario. However, being expensive in such a challenging macroeconomic environment opens the door for significant downside correction in case the adverse scenario materializes. What I'm trying to say is that in the case of a severe recession and further earning downgrades, stocks have a long way to decline until they are fairly valued according to this negative outcome. On the contrary, there is not really much positivity that could be priced in, as a soft landing without an earnings apocalypse is what reflects the current valuation of stocks. Now, for that reasons, I consider the risk to reward ratio unattractive, and we should also consider that bonds are paying a considerable return for the first time since the 2008 crisis, while they also provide a shelter, let's say, for the adverse conditions that currently are active in the economy. Overall, that's why I think that the risk to reward ratio is unattractive and stocks should decline significantly from where they are now in order to be attractive for investors.
Stefanos, thanks so much. This was a special report on the quarter one earnings season here at XM.com.